All right. Hey, everyone. Investment Tuesday here. And I got some good stuff for you guys. Some really good stuff. I like the format that we had last week where I talked about the general market and then we went into, I think is, going to be some great opportunity. And I think we're going to keep that format, which is like talk about general stuff that matters because there is a lot of general stuff going on. There are some deadlines coming up that matter for the market, and you can bet that the markets will use those dates as event betting. And as we get closer to those dates, you'll start to see more volatility. People start to move out of the way. That's just typical markets, event betting. People will start to go long, go short, and all these things. So it's good to keep in mind, all these things. So cover some of that, and then I'm going to talk about, I think, a bull market that's forming. It's one of my, one more secret bull market where increasingly we see signs like investors believe that there is room for this innovation to run, that there is money that wants to go into it. There's obviously money to be made from it. And yeah, at the government level, all these things, the obstacles, the regulations are surpassable. In other words, nothing really stands in the way of this starting to move forward. All right. So we'll talk about that. Don't want to give it away. Got to be a little bit of a tease, right? I mean, heck, we give the ideas away for free. I mean, it's coming. It's coming. It's coming. But you might get a sense from, my green thumb gloves what this idea might be. Well, okay, maybe you don't. But okay, let's get into all of it. But let's keep the lawyers fed and happy. Do the legal disclaimers and disclosures, which is that this video and the content from ATG Digital is not investment or financial advice. It is presented to you as opinion, information, engagement, and entertainment. I think entertainment might be the key factor, but ultimately it's our opinion. I mean, it's our take, our view on the world. It's not like certain to happen. It's not a guarantee. There's no magic crystal ball just because, I've got a head that's shaped like one. All ATG Digital content may contain errors, oversights, mistakes. Understand that investment operations, which is what? Well, buying or selling a stock, crypto, options, have significant risks and can lead to the loss of your principal. You can lose money. We never have to talk about the reverse, about making money, because that's a happy outcome, right? I mean, you watch a video, you get an idea, and you make some money. Pretty good. I, the owners, employees, contracts to ATG Digital, we own, trade, transact, the securities are mentioned in this video and all content from ATG Digital. It's pretty self-explanatory. We do not take money from company managements or from crypto promoters, sponsors, whatever you want to call it, to recommend their stocks or their crypto tokens. This is a widely done practice today. Influencers, YouTubers do take money. They are by law required to disclose it, but they don't always do. Next, quickly, why is this not showing up? There we go. These are our various contents. We got the Substack, the podcast, and then me on YouTube pretty much every week. Social media, X, Instagram, Facebook, we're active and reasonably active on all of these. And then finally, if you'd like a subscription from ATG Digital, you go to atgdigital.media. Subscription plans are monthly and they start at $9.99. That will, I think, we'll keep that going. All right. So let's talk about, let's just like quickly review like this year, right? I mean, or even, the end of last year, we got this rocket ride up, right? Pretty much, which like takes everything higher, crypto, stocks, everything rides higher. And then it flattens out for a bit. Then we get Liberation Day. Then we have a crash. Now we have a recovery, all right? Yeah, and many people probably think it's all clear. Look, we can go back to trying to bet on what AI stock is going to happen, et cetera. Everything is just hunky dory. And I'm here to tell you, I don't think so. That will not be popular, welcome, or desired, but that's my opinion. The bond market, as I explained last week, is telling you very clearly that there's problems, major problems that are related to issues that I don't want to spend a lot of time on. I can recommend some really good videos. If you watch the channel called Forward Guidance, they've got a number of people on that explain the issues around government debt, how it can be financed, at what interest rate, what it might do to the value of the US dollar versus a number of currencies, what that would do to gold prices, Bitcoin prices. It's a pretty complex wide web with a lot of interconnections. I would have to sit there and talk for a while and also plan it out because they really are all together. But bottom line, I would not be sitting easy thinking like, well, markets have ripped, everything's back. The S&P 500 is up for the year. The NASDAQ 100 is up for the year. The Mag 7, are recovered XYZ. It must be that everything is fine. No, I think underneath there are like all the issues that Liberation Day brought up. Yeah, they haven't gone away. I mean, they're there. And like I said, it has to do now with our huge amount of debt, the value of our currency versus number of currencies, the value of all currencies versus gold versus Bitcoin. How are we going to fund our government if foreigners don't keep buying our debt? How are we going to get production here to the United States? How are we going to negotiate good terms with all of our trade partners? Extraordinary amount of uncertainty, and the markets are not priced for it. In other words, the stock markets are anticipating record highs into the future. And I say that because of where the estimates are, where the profit margin expectations are, and even a very basic, simple math of the temporary trade agreement with China, which is for 90 days, which is for 30% tariffs on our side, 10% tariffs on that side. That's not a like a it's a positive in the sense that it gave people an answer to like, okay, at least like we can start shipping stuff in for back to school and maybe anticipate stuff for like Christmas. But if you are a importer of goods and you're facing a 30% tariff, you got a difficult negotiation with China, your Chinese supplier or any other supplier that says, well, let's say with China, I've got to pay 30% tariff to bring your goods in. Who's going to eat that? The importer is like, you eat that. And the exporter is going to be like, no, I think we should like share it. And I proposed this idea with a 30% tariff, which is, significant. Just imagine like a 30% increase in the price of some toy, some piece of clothing, some piece of furniture, components. I mean, things that go into your house, pipe fittings, electrical fittings. I mean, 30% is pretty substantial. So there's pain to be absorbed. So let's just assume that the supplier is not going to eat all 30. They're almost certainly they'll eat some of it. Just for simplicity, let's just use this model. The supplier eats 10%. The importer says, well, I don't want to lose my customers here. I know even if I raise the prices 20%, I'm going to lose some market share, or I'm going to lose people who are going to delay purchase, substitute, or simply say, yeah, I don't really need that. So they might eat, but they might try to, push another 10%, the importer eats 10%, but there's still a 10% left that they got to extract from somebody. And the only person left is the customer. A 10% increase, now companies, an importer or whatever is thinking about, well, I'm not going to keep all my customers. I'm going to definitely lose some customers. Why? Well, because wages haven't gone up by 10%. So a customer is, unless they absolutely need that thing, they're like, I think, this back to school, we're not going to buy that. and maybe this Christmas we're not going to spend as much money. So very quickly, you'll start to work out that come the when the second quarter results are announced starting in July, right? It's going to be quite predictable what companies are going to say, right? They're going to say, look, our guidance that we gave you in the previous 2 quarters is no longer going to be good because we now have an answer, let's say for back to school, we know what the tariffs were, we've priced that out, and we're going to expect lower sales, right? That's completely reasonable because if you're going to have to increase prices, maybe it's 5%, maybe it's 10%, whatever it is, you're going to lose some customers because customers' incomes haven't jumped. I don't have, more money. So sales are, sales and sales growth is going to go down. And then on top of that, to the extent that they are eating some of this tariff cost, their profits are going to go down too. So lower sales and then lower profit margins. So if they were making 30% before, now they'd be making on every sale, let's say they're now making 20. Yeah, both of these are negatives. I mean, so the markets have, like just shot prices higher with the idea like good times are here again. Everything's okay. Everything will just be there when we've just went from like essentially like a nuclear scenario, like an all out trade war embargo. Nothing is, being sent from China to here, to where it's, it's sort of like, yeah, we went from like an all out, like a zero sum game to something that is, best case scenario, less bad. But, it's still bad. And it's now quantifiable. We know the number, 30%, right? I mean, and we can now begin to work out. So we will flesh out over, starting July, companies will start to tell you, hey, our guidance from before, no longer any good. Our profit margin guidance, no longer any good. And they will now tell you, well, we now think sales will be whatever, 10% lower. And our profit margins will also be 10% lower. The reaction of investors to that is not going to be positive unless they have anticipated that. In other words, if the market had stayed crashed and gone down some more, then it would have anticipated lower sales and lower profit margins. No, instead the markets have ripped higher, right? So the market is a, anticipation machine, looks forward. So the higher you go, the greater the disappointment is going to be in reaction to what is going to be announced in July and August as the second quarter results are announced, which will be okay. But remember, markets look forward. It's not about the past, it's about the future. But as they project forward into the third quarter, into the fourth quarter, into the first quarter of next year, it's going to be less good than 2024. All right. I mean, so, and this is what, what the game on quarterly results is. You compare it to the equivalent quarter from the previous year. So, for the June quarter, you compare it to the June quarter of 2024. These comparisons are going to be negative. And in that scenario, the reaction of most investors that play the short-term game, that play the performance games, which are hedge funds that got it, they have to meet their bogey. What is their bogey? It's their standard that allows them to earn fees, earn performance bonuses, keep their clients, which is keep up with the S&P 500 or beat it, or it'll be, it's some marker like that. So what are they going to do? Well, they're going to run out of stocks, and maybe go short or something like that. So bottom line, I'm just telling you, don't get carried away by the price movements here. Just by, not using genius logic, you can work out that the guidance and the numbers, for the second quarter will be okay. And people be like, but look, Paul, they reported a great number. No, but you have to go look at what they are guiding to, what they are forecasting, what they're anticipating, because the market looks forward. You yourself, when you think about it, do you invest for something that happened or something that's going to happen, right? Everyone else is like the same way. So, I think I can take these. Yeah, no, I'll wait for the big reveal moment of the stock and the sector before I do that. So that's point number one, right? Then there's two deadlines coming up, right? And we know if you were, trading markets in 2022 as the Fed was raising rates, and you remember all the event betting. What's event betting? When there is a date for a piece of information or news that everyone can bet on, using futures, using options, by being short, by being long, whatever it is, people will bet on it. So in 2022, as the Federal Reserve was like lifting interest rates, every CPI release became an event, right? And people would load up on, stock futures, bond futures, options, etc. And the moment it was released, the trading would go haywire. I mean, essentially, it's like racetrack betting, right? I mean, you're essentially betting on like a particular event. It doesn't have a meaning for asset prices long term. It's just betting. It's reflecting the demand and supply of the particular moment, and then those bettors move on. But that went on for a year. I mean, the CPI betting, and then the employment number, and then on the Fed minutes. So this is all event betting. And we now know, like, once a date is set for something, with the number of financial instruments that are available, futures, options, obviously stock, shorting, leveraged ETFs, people will load up. People will load up. And so prices will start to move in anticipation of that date. And then for some period after that date, depending on how the betting was into the event, there will be some cashing out and reconciliation. So it's not just like, oh, you have to not just anticipate what is going to happen, but you also have to understand, like, what are the demand and supply dynamics at the moment? For example, let's say there's some good news, right? At the end of the event, but if people have already incorporated that, then any bets that like bet on the good news coming out would actually not do well. I know it sounds complicated, but the bottom line is that, there's going to be a lot of event betting that happens around this, and it's going to be complex. It's not going to be easy, and it's not going to be a straight line. In other words, you think, well, I think it's going to happen is be for sure. If that's already anticipated, if that's already something that's in markets, there's going to be no reward for it. But that's not my point. I got distracted from the point, which is that there are two major deadlines coming up for the trade war, right? And I got up two headlines to show. So the first one comes up on July 8th. So if you remember, our markets crash. President Trump comes on and says 90-day pause for everybody except China, right? So July 8th is a deadline number, and you can bet that starting, I'll say, probably about now, because remember, options expire about 2 weeks before month end. Same is true for futures, and June is a major options expiry month. So the betting has already begun a little bit for like, okay, how many of these countries will have signed deals? What would those deals be like? And then if those deals are struck, then quickly people will start to work out, well, okay, XYZ company has big operations, let's say in Korea. Their profit margins are going to get shrunken by, whatever, 10 or 15%, because that's the deal that they struck. So July 8th is going to act as a big event betting day. People will be betting using options, using futures, etc. And both sides meaning politically here in this country, being where we're so polarized, will look to spin this as either some, everything's great or everything's terrible. And then obviously between countries, everyone will want to posture for their local consumption that they won, or at least they extracted the best deal that they could. But either way, July 8th, as that deadline starts to approach, you will start to see people my best guess is start to take profits, come out of the market more and more. But that's just the first deadline. The even bigger deadline really comes. Let's see here. Yeah. Comes when the China temporary deal expires. So the expiration would be 3 months from May 14th, so August 14th. So we're now May. I'm recording this on May 16th because I'm headed out on a trip. I can't record it any later than I can. But this it's May 16th. So by the time you watch this, which will be in about 3 or 4 days, we'll be closer to June. So we're within the calendar period where this kind of betting and thinking about like, well, what if, what are the major partners for the July 8th deadline? Well, it's Japan, it's Korea, it's the European Union, it's India to some extent, although, the United States is not a big trading partner with India. But Japan, big. European Union, pretty big. Korea, pretty big. Collectively, those three, good size. So that matters. But people probably would be like, that's not as important as this one, which is the one with China. I mean, that's the one that matters. So as we get closer and closer to both of these dates, July 8th and then August 14th, you'll start to see a lot of volatility. And being that this trade war is really pretty, there's so many dimensions to it. There's a dimension that affects treasury bond yields. There's a dimension that affects currency exchange rates, which goes into gold, which goes into Bitcoin. There's obviously the impact of these tariffs have huge meaning for growth for various companies. If it's just going to be at the base 10% tariff rate, that probably is pretty manageable for most companies. They can maybe increase prices by 2 or 3% and not lose a lot of customers, and their profit margins shrink a little bit. So that would be like the best case scenario. But if it's going to be something like 25, 30, 40%, the reaction is not going to be good, especially because markets are ripping higher. They are looking backwards at 2024, not thinking through the implications of the tariffs, of the effects again. I mean, for not even of the tariffs, let alone the fact that the bond market already doesn't like what's going on and is pushing interest rates higher. The response to the China deal in the bond market was not positive. It was negative. In other words, yields went higher. And you want the reverse. You want interest rates to go down. In other words, they viewed that deal as still being something that would, in the medium to long term, be inflationary. So that's, a negative because you want interest rates low. Interest rates, are to the financial system as gravity is to physics. You want higher valuations, you want lower interest rates. Higher interest rates means lower valuations for anything with risk. Why? Well, because you can get, a 4 or 5% return by taking no risk. Why are you going to, go into the stock market? Why are you going to go anywhere? Then there's, follow-on effects to currency markets, which has follow-on effects to gold. And that which in turn have follow-on effects for the next stage or whatever is going to happen with this trade war. Bottom line, right, for the general view, don't be taken in by the price moves we have seen since I think the first reaction move was after the 90-day pause was announced for everybody except China. The next set of moves came after the China deal was announced. So don't be taken in by it. Even if these things become, let's say, the permanent, or let's say semi-permanent, last for 1 year or whatever, it still means that any company, and that's pretty much every company today, is going to see lower sales and lower profit margins. It's just the degree that matters. In other words, all forms of of this are just in some category of bad. None of these are good, right? So that's there. Then we've got two deadlines around which there's going to be a lot of event betting, which won't necessarily just go with, let's just say there's all countries, let's just say 100 countries magically get their deals done by this deadline of July 8th. In theory, that's good news. However, if markets have ripped higher already and are sitting at highs, my best guess is that you'll actually see a sell-off in response to this, right? If there are particular pieces of the trade news, let's just say Japan is not one of these countries, which is a major deal, then the sell-off might be a little bit more significant. And then that then sets the stage for the next sort of event, which is the expiration of this temporary trade deal with China, which would come August 14th. And if they renew it, then what it does, it makes more permanent and more certain that every company that is supplied by any supplier in China, they're going to have for sure lower sales growth and lower profit margins. But we know now what it's going to be. It's 30%. And since markets have ripped higher, they haven't anticipated that, right? So a confirmation of this would send stock prices lower for pretty much the vast majority of companies. Equally, they would now start to permanently price in that companies that have US production, like in furniture or making things, that they are going to see rising sales and rising profit margins. And yeah, money will start to move more aggressively into those. Those are part of, if you're a subscriber at ATG Digital, part of our Made in America theme. In other words, we can see very clearly, if you are looking at stocks, there is a clear bid. By clear bid, meaning there is active buying of companies that still somehow, through 30 years of globalization, through the gutting of of our production and manufacturing, they somehow held out and they have production facilities here and they're making things, and those stocks are getting bid up. And I believe that what you will see is like a bigger move in those stocks as these deadlines come and some version of bad news gets confirmed. It's just going to be less bad, or it's going to be essentially like a gradient of less bad to terrible, right? I mean, all of these, any trade deal is going to be worse than what we had before. Just so we can put that in context, pre-tariff or trade war, the average sort of like tariff that anybody paid approximately was 2.5%, right? And as it currently stands, with 10% on the rest of the world, 30% on China, again, I'm just very broad number, we're at 13% on average. So that's more than 5x what it used to be. So it's some version of bad pretty much for everybody, unless you magically have production here and where you're like, okay, wow, if I, essentially just price just below whatever the competitor that imports things in, I can gain market share and I'm still profitable. I'm more profitable. So there is a lot going on in the world. it is different than the bull market from before. It's complicated, it's complex, and the details matter. The details matter. But this is all going to come in the next couple of months. So if you're someone that likes to follow the markets, you're a market junkie, maybe you trade actively, yeah. The first deadline I would be mindful of is July 8th. And the next deadline that I would be mindful of is August 14th. There will be volatility, there will be betting, and there will be a period right before and right after when this will pretty much consume markets. All right. And then we'll have, I don't know, maybe we'll just have another 3-month deal with China to get us through Christmas. I don't know what it is, but we'll have something that happens. Now, it's always possible with the China deal that something happens before that. And once again, because markets are higher, they are not anticipating any of this, right? They're anticipating essentially that things are going to go back to where they were in 2024, when that's just not actually on the table at all. That is just not on the table at all. So bottom line, if I was someone that was like looking backwards, and the vast majority of, I think, individual and retail investors don't spend like enough time thinking about these big macro issues, or think them through the perspective, well, I own this and so it must go up. I would say consider your exposures and be mindful that this is a very complex environment. It is not what it was between 2009, I'll say, until 2024. There are so many moving parts. The prices are quite elevated, which means the risks are quite high. And I would be much, much more careful about how I go about doing anything in the markets today. So that's the general comment. All right, now let's move to the secret bull market that is clear to me from watching markets that investors are willing to support.
There's a new bull market in town, but it won't favor the timid or those smitten by old market darlings. No, this bull market is for the bold, those willing to ride new horses into the sunset. We would know. This ain't our first rodeo. To grab the bull market by the horns, get your Trade War Survival Guide available in the description of this video.
And that is the bull market in autonomy. What's autonomy? Essentially taking away the driver from trucks, taking away the driver from cars. You see, that's why I got my driving gloves on. I'm in my Cybertruck, wear my driving gloves, and not really. I don't actually do that, but I'm going to take these off for now. But there is, in my judgment, in my opinion, a bull market for autonomy stocks. And that kind of makes sense within the context of the trade war and us trying to bring production and manufacturing back, being that our current transportation system is built to essentially ship things, let's just say China, to some port on the East Coast or some port on the West Coast, put them on trucks or rails and have them shipped to different places, right? Now, if we're going to start to make things again, not that, we're actively, making a lot of things, but nonetheless, you got to think 5 years forward, 7 years forward, for which you'd have to begin at some point in time. We'd need a new transportation network, right? Because you would have your supply chain in different states, different cities. And right now we're essentially just constructed to ship to ports here, put them here, move them to some central point. Maybe it's Chicago on the East Coast, might be, I don't know, Kansas City down in the Midwest, and then everything's gets pushed out again by trail. It's a completely different, you'd need a completely different network. And that new network, being that it's fairly small, is kind of perfect for an innovation which can't scale up like that. Like, it's not going to, jump to, we're not going to have self-driving trucks suddenly become the norm across the country, but it can build on incremental volume, sort of route by route, right? And where it can take on smaller loads and and the sort of like the per pound cost, is worthwhile, that they would take small amount of market share on like on a route by route basis versus an old school trucker, right? So this company here, which we have been invested in at HG Digital for a bit, I think Aurora. Let me just look here. Okay, 2023 Aurora Innovation we bought at $3.26. So we're up like about 100%. So Aurora Innovation was one of several companies that chased after this, self-driving opportunity in trucks. I came to Aurora Innovation because Uber, which was one of the early pioneers in self-driving, along with Tesla and along with Waymo, when their investors rebelled and said, "We're tired of you spending money on this. Please spin this company out or get out of this so we stop losing money." They sold their self-driving technology patents, etc., to Aurora Innovation, and they took a stake in Aurora Innovation in exchange. So Aurora Innovation had lots of technology. Then they got Uber's technology, and they are arguably the leader in self-driving trucks, and they have now launched their very first actual route. In other words, this is a actual robot that is driving, and it drives between Dallas and Houston. So there's no safety driver in the cab, and the cost in trucking is obviously fuel. There's the cost of the truck, but a truck lasts many years. But the main cost is the driver, who's got to sit there and monitor the truck. And for the most part, for these long haul routes, you're on a fairly straight line, and especially this route is pretty direct. So it's perfect for an introduction. But they're now operating. This is no longer a concept. This is no longer an experimental technology. This has gotten regulatory approval. It is actually hauling customers. If you look at this article here, let me make this a little bit bigger. You can see, so the first two customers are Uber Freight, which of course makes sense, being that Uber has a stake in Aurora, and they'd likely have some connections from having developed some of this technology. And then there's another company called Hirschbach Motor Lines. This is happening. It is beginning to produce some small amounts of revenue for this company. And let's switch and start to look at Aurora as a stock. Let's look at that. So $6.67 stock, market cap of a little bit under $12 billion. Here comes my regular rant about not judging a company by its stock price, instead looking at the market capitalization. 11.8 billion, $12 billion. I mean, in a world of multi-trillion-dollar companies like Apple, still fairly small. If they can keep the lead that they have this small lead. In other words, they are the leader, and not just a leader in terms of technology. They're a leader in terms of now they actually have, they're carrying goods. Somebody's paying them for this, which is always a big deal. A lot of times I get asked questions about like, Paul, what about this technology? It can do this, it can do that. Yeah, but can it earn money? Because if it can't earn money, then investors, yes, there's, obviously a speculative play that you can have on it, or on news like, oh, they have this announcement and the stock pop. However, for even a medium-term speculation, or certainly for any long-term investors, it's got to produce cash flows. It's got to produce sales growth. There's got to be something that, that comes after that people can anticipate, forecast, and count on. So Aurora Innovation is early. Let's look at what its stock looks like over the last 5 years. This is a weekly chart of the last 5 years. Came public at about $10, shot up to about 17 in 2021 when everything ripped, got crashed all the way down to $1. Now is, after peaking at about $10 or $11, around the time when this commercial, launch happened, it's now back to about a little under $7. Now, if I shorten this chart up, you'll see here, which is on May 14th, the stock gapped down. In other words, there was so much selling at the open that the dealers had to make the price significantly lower than the previous day's closing price. That's called a gap down. And gaps down often indicate a demand and supply imbalance. If you see a gap up, it means there was so much demand that the dealers forced to open the stock significantly higher than the previous day's close. And I'm often wary of these kinds of gaps, both on the upside or on the downside. On the upside, it means that that price is potentially of a buyer that might be just short covering, or else they're a large retail client that probably doesn't have a lot more money, and that gap will eventually get filled as their buying stops. The money just moves back down. With a gap down, oftentimes it like this gap down came after its earnings results. So somebody was betting on, I guess their sales maybe instantly booming, or maybe them guiding to them having like instant huge sales, which seems delusional to me, but people will bet on almost anything. But I was curious to see what would happen, like in the day after. And I believe between dealers and long-term investors who believe in the story, believe that obviously the stock can go higher, but that the forecast and the sales growth can be sustained, and that there is more business that is likely to come the way of Aurora for their current route. And then they plan to launch into several more routes over the next 6 to 12 months. They believe that there is a revenue growth story here that is going to be supported by investors. Obviously, it would have to be supported by regulators, by government. You have to operate across interstate lines. It's a pretty complicated world. If they can get into 4 or 5 routes and states, given how complex this world is, because trucking is quite regulated, and each state has its own regulations, that leadership is unlikely to be given up by companies. So they're likely to be a leader in this and sustain that lead. And once they have that lead, and they just keep branching into more and more routes, this could end up being like the stock for trucking autonomy, for truck self-driving. So let's look at this as a company and just look at what are the analysts who, they could be completely wrong. I never completely assume that this means anything, but if we look at their estimates for this year, this is an up-to-date estimate of like analysts is about 4 million, which is reasonable. They just launched this product, right? But it's $11 billion company. So, obviously investors, no one is currently betting on this going bankrupt, right? And then for next year, while the number is smaller at 41 million, it's 10 times what it, would be in success mode. And that is, I presume that's not really betting on, multiple routes. So they're expecting 1 or 2 routes to generate 40 million. Um, this is about as much visibility as we have into the future. But I'll say between even 10x, the picture froze here, the 10x growth for a technology that, I can say for the vast majority of the time I've talked about any sort of self-driving, people have told me I was stupid, dumb, delusional, an idiot for thinking that this was ever possible. Yeah, I think that will be seen as a victory and would bring in more investors willing to pay a rising multiple on future sales. And if they can get a couple more routes going, the future estimates for, let's say, 2027, 2028 will start to explode higher. And people will start to price that growth in and start to pay rising multiples. Now, many people focus on when they look at a business, they think like, oh, the business growth is what drives the stock. It's actually for a growth stock like this. I mean, they're not making money, right? I mean, we'll find out probably in 2 or 3 years. There's going to be some level at which their costs are going to be accounted for. I mean, it is ultimately a software platform. So it's a fixed cost business. And once they get enough routes and they run enough trucks, they will not have the economics of a regular trucking company. Instead, it will have the economics of something like Uber, right? In other words, they have a fleet, and then they have essentially like a network effect of using this fleet that uses their software. So money will start dropping to the bottom line. If that's the way that the investors will start to view this, and we don't know because it's too early, we don't really have an established business model, it's very speculative, then those future estimates will start to be multiplied. It'll go from, like, right now we are at very modest, but sales, but a price to sales of 164 times. So many people are like, Paul, that's a delusional thing. But what will happen as the sales estimates go up is that price to sales ratio will start to become more reasonable, but it will still stay plenty high. So we're going from 4 million in 2025 to 40 million in 2026. And let's assume that the 40 million by, the end of this year, people be like, well, we can see them going through the regulatory process in neighboring states. In Arizona, they now have 6 routes that, will come good by 2026. The 40 gets to 50 million. And now we start to have an estimate for 2027, which is, let's say, 100 million, 110 million. Even as this multiple goes down, the stock price can go up because the revenue growth is there, and the price to sales ratio, while it won't be maintained at 164 times sales, which just reflects the facts that it's at launch, and people clearly believe that this company can be the leader of this potentially very large business, which we are dependent on. I mean, everything that we get, everything that we eat is transported multiple times before it gets to us. So if this fairly small company were to capture this lead and to build on it, this would become, a leader, like the way Uber became a leader. They were the first in bringing, essentially an external fleet, networking it together, capturing customers by virtue of their app. Aurora Innovation could have, a similar performance trajectory like Uber did. I mean, if you want to look at Uber in the early days, right? I mean, let's look over the last 10 years. It's up, it's up 116%, but this is after, it hasn't quite, it's just made a new high again. So, 116%, it's 193 billion dollars. My best guess, is that most people have made a little bit more in Uber than what that would be. Most people didn't buy the IPO. I mean, I can't remember what our trade was when we sold it, but yeah, I mean, the last 3 years, Uber 270%. That I think is what Aurora can do. In success mode, its revenues will rise. The multiple will be, I don't know, 15 or 20 times sales, and you could get a stock price that is very, very high. All right, so that is my secret bull market that I wanted to talk about for today, which is in autonomy. And quick plug for HG Digital, I also just added a robotaxi stock to Diamond Tier. Diamond Tier is our small and nano cap and micro nano cap tier at ATG Digital. It's the second most expensive tier. We added that because what's going on with trucks is also going on. As you know, Tesla is on the verge of introducing the Cybercab either next month. It's going to come sooner rather than later. I'll put myself out there and I'll say by July this will be there. And then we got Waymo, which is expanding into a number of other states. But there's also a company that Uber has signed a deal with, and they are launching operations in other countries, like in Spain, in Abu Dhabi. So autonomy is taking off around the world. It's not just one thing. So investors are seeing the potential, and they're like, even with all of the trade war, all the issues, they're like, this innovation is going to be backed. It's important. It's real. And we think it can make big money. So, all right, I'm going to end it there. I hope you enjoyed this Investment Tuesday. Thank you for watching. And yeah, if you want ideas like this, analysis like this, atgdigital.media is where you can go to find it. And I will be back next week with a different background because I'll be working remotely from Asia, and I'll do an Investment Tuesday from there. All right. Thank you all for watching. This is Paul saying thank you and goodbye.